Welcome back to On the Money with your financial advisor, Ryan Wheelis, right here in Texas. But if you're watching us on the YouTube channel, anytime you see that phone number, anytime you hear the text plan, you too are able to reach out to us, 844-944-7555, or text us the word plan at 21000. We want to help as many people as we possibly can right now, especially with volatile markets. Now, this is what always blows me away, Ryan, is that you're able to come up with glasses half full things to think about while the markets are down. Number one, I'll hit you with this, rebalancing. You said this can give us good opportunities right now to move things around because of rebalancing. Are we buying more of the low right now and hoping that our other sides come back higher?
Yeah, we certainly can, Spike. So one of the things we're doing right now, and we've been doing or have done and have been doing, is a lot of times people come to us and they have annuities. And those annuities have the ability to take out 10% a year without penalty whatsoever, without any fees or costs. The client has access to 10% of their money. Anybody tells you that their money's locked up in an annuity needs some more education, because it's not, all right? So we take 10% out of the annuities and we move it over to the markets, all right? We capitalize on down markets using the safe money out of a safe program, and we believe that the markets have upside from here, okay? And I do believe they have upside from here, and I do believe when Trump leaves office, the markets will be higher. I can't think of many presidential cycles, 4-year terms in history, 8-year terms, to where the market did not end higher 4 years later or 8 years later than it started, right? Regardless of who was in office, okay? So that's been all the way back to John F. Kennedy, okay? And so the reality is we think that's going to happen. Now, another thing you can look at is if your portfolio is, say, a balanced portfolio, 50% stocks, 50% bonds, maybe now is a time to compartmentalize. If you've got $1 million portfolio, for instance, maybe you take out, at 10%, $100,000, and be more aggressive right now. Why? There are so many names in the S&P 500 that are beat up like crazy, and I believe that they will go higher in the future. So it's a time for opportunity, right? People are scared right now, okay? When do you buy? When others are fearful. When do you sell? When others are euphoric. That's when you sell, right? And so that's the way it works. And that's straight from Warren Buffett's mouth, by the way, okay? And so right now people are experiencing a lot of scared. They're scared, they're concerned. I would be figuring out ways to layer on risk right now. But once I figured out how to layer on some risk, I'd say to myself, okay, once the market's kind of back to this level or that level, I'm going to start layering that risk back off. So you have to have a process for bringing risk on, but you also have to have a process for bringing risk off.
Another one I want to ask you about, and again, because we've got drivers who are driving around listening to the radio show right now, tax loss harvesting. Is this something to take advantage of right now because of compression of the markets? We have losses right now. So is this a time, or is this stuff that we need to evaluate more towards the end of the year?
Let's talk about what tax loss harvesting is, Spike, in a nutshell. If you have two stocks in your portfolio and one's way up and one's down, okay, you can sell the down stock and book that loss on paper. Then you sell the stock that's up, and you sell enough of that stock that's up to fully use up your loss. So you basically just tax loss harvested your gain, okay, on your up stock, and you paid no capital gains tax on it because you used a losing stock to offset the gains in a winning stock, all right? Now, if you have a stock that's down, like I do right now, one of the stocks that makes Ozempic, by the way, okay, I'm down big time in that position. Now, I'm not down. I'm actually well ahead of what I initially bought it for, but from its high, I'm down. So what I could do is I could take that stock and sell at a loss, all right? And I could go sell some of my stocks that are gains and kind of use that, right, to offset losses with gains and pay no tax on my gains. Now, I believe that Ozempic is here to stay, and as much bad press out there on it, I've actually seen results of people's life change with it. Okay.
Yeah.
And so as a result of that, I think the long-term viability of that position is strong. So I'm only going to do that. I'm not going to sell the Ozempic stock and just be done with it. I'm going to buy it back. I have to buy it back 30 days later to avoid something called a wash sell rule when tax loss harvesting. All right. That's some tax stuff. We do a lot of advanced tax planning at Allied Wealth. You're not having a conversation right now with your advisor about the next question Spike's going to ask me, I know, about tax loss harvesting and Roth IRA conversions right now. You need to pick up the phone and call somebody else, okay? My number is 844-944-7555. Again, 844-944-7555. Text plan to 21,000. That's plan to 21,000. Now, Spike, going back to this. I'm not saying you sell your losing stocks and just go away and never come back and buy them again. If you believe in the long-term investment thesis, which I do in this particular stock, okay, I'm going to buy it back 30 days later. I'm going to hope it hasn't gone up tremendously. Maybe it has, but I'm going to use that to capitalize on harvesting gains out of my portfolio. Now, one thing that's really important to understand here, okay, if you're going to tax loss harvest, it's opportunity-based. So if you're going to do it in a year and the market's down 20%, take advantage now. Don't wait till the end of the year because I'm going to bet $1. I'll bet you $1, Spike. Okay. That the market ends higher at the end of the year than it is today.
Okay.
I bet you $1. Okay. And so I'm saying that because I think if the opportunity presents itself, you take advantage of the opportunity when it's prevalent and present, not just waiting blindly until the end of the year.
Okay, so you can do those right now. So you can lock in those gains and those losses. And even if those individual stocks, whichever they are that you bought and sold, actually come back up higher in value, it's okay because you did it on paper. And since you executed the trades, you locked in those gains or losses. So it doesn't matter if it's later. Okay, all right, so you can do it now.
But and again, if you're trying to create a situation where you harvest enough gain to where you don't pay any tax on the gain. And ideally, the stock you sold at the loss doesn't move for 30 days. You buy it back, and then slowly but surely it makes its way back up too, and you're taking advantage of opportunity there.
Yeah. Respectfully, with all of the people who have come through your offices and even come to your live events, how many people are able to do this on their own, execute this properly on their own? I mean, this is kind of like running up and down the stairs with scissors.
More importantly, Spike, I mean, they can do it on their own, and plenty of do-it-yourself people out there are out there, and they know what they're doing. They're not dumb, and they can do it all day long, for sure. Most people who work with advisors, by the way, aren't having the conversation with the advisor. And the reason why that is the advisor's precluded by the company they work for or bank they work for from giving any tax advice whatsoever. Go call your CPA. You call the CPA, I'll do some tax loss harvesting in my stock portfolio. Hey, call your advisor. Hey, advisor, we'll do some tax loss harvesting in my portfolio. Hey, call your CPA. Hey, call your advisor. Hey, call your CPA. Can somebody please stand up and help these people? I mean, what are we doing? What are you paying that advisor for if they're not helping you with Roth IRA conversions, tax loss harvesting in your portfolio, how to properly create a distribution strategy out of your retirement accounts and your brokerage accounts, mixed with the Social Security timing strategy and your Roth IRA distributions and your dividend income coming out of your passively managed brokerage account, coordinating all that together so that you pay the least amount of taxes possible. What are we doing? That's
why I love the way that your practice is designed, that it's not saying, do this part over here, do your estate planning over here, do your taxes over here. No, you've got to put this all underneath one roof. And that's what you can do very simply with a text, a phone call, 844-944-7555. For our listeners and viewers, you call that phone number. Somebody will schedule an appointment for you right now. You text the word plan to 21000, hit send. We'll get in touch with you. We'll schedule the appointment for you. And now you gave away one of my other leads. Things you can do to take advantage of a down market. Roth conversion. Look, you got to explain why, though, this is a positive right now. It's not about timing the market. We're not trying to time the market. We're taking advantage of what's happening right now.
Okay, Spike, it's really easy, all right? If I have a $100,000 IRA and I have one stock in that IRA and that stock is worth $100,000, and I want to do a Roth IRA conversion, meaning I want to take the $100,000 stock out of my IRA, move it over to a Roth IRA to where I never pay tax again. It doesn't, the distributions from the account do not increase the taxes I'm going to pay on my Social Security. And yes, folks, your Social Security is taxable, okay? But the Roth IRA distribution does not count towards my taxes that I pay on my Social Security. I don't have to take any RMDs, required mandatory distributions from it. And my beneficiaries will never pay tax on the money ever again either. And my wife can use that, my spouse, surviving spouse, in the event I pass away, to take income from because she's going to pay the widow's tax that so many people don't even talk about. All right. So I take that $100,000 stock out of my IRA, move it over to a Roth IRA, and I pay tax on $100,000, and my money and that stock is never taxed again. It goes to a bazillion. It's never taxed again. Okay. Well, that's a good way to do it.
Mm-hmm.
All right. Now, there's other tax implications you should think about. IRMA, income-related monthly adjusted amount for Medicare. A lot of stuff goes into that. Make sure you talk to a financial advisor who can provide you guidance on this stuff before you do that. Okay. Now, what if my $100,000 stock that I believe in, that I know is going to go places, is currently down, not because it's worth less, because a company's not going to do well in a tariff environment or not do well in a recessionary slowdown, but just because the S&P 500 is a cap-weighted index, and the big tech stocks who've been had the butts kicked here lately have fallen dramatically and pulled the value of my stock down with it. Well, guess what? That's a golden opportunity for you. Because if that $100,000 stock, just for easy purposes, has gone down 50% in this market downturn and is worth $50,000, convert it to Roth. You get a discount on the taxes. You're paying tax on $50,000 now instead of $100,000 now. You just took great advantage of the market being down. You take that $50,000, you pay the tax on it, move over to the Roth, and now when the stock goes back to 100, you just realize that $50,000 gain, 100% tax-free. And if the long-term thesis of that stock that you thought was in play before you invested your money in the stock to begin with plays out and it turns into $1 bazillion, guess what? You saved yourself a lot of money in taxes, and you will never pay tax on that stock again.
I got a very excited Ryan Wheelis, financial advisor, founder of Allied Wealth, but I have to take a very quick commercial break right now for the radio. Call the phone number. Let us do your portfolio review. There are things that you can take advantage of when the market is compressed the way that it has been. There's probably going to be market volatility all through not only this year, but I think, Ryan, through the next 3 or 4 years. So make sure you're in a volatility risk portfolio that you can stomach right now. And there's a couple more advantages we're going to talk about when we get back. And I need just a little bit more on the Roth conversion, so please don't go anywhere.
Sure.
You can also text us at 21000 and type in the word plan. Hit send on that. We'll schedule an appointment for you. More with Ryan Wheelis right after this.